According to Kobyakov, the United States is preparing for a hidden devaluation of its massive national debt, which exceeds $37 trillion by using cryptocurrencies and stablecoins. Stablecoins are digital dollars. Their price is always equal to one real US dollar because they are backed by real reserves, cash bank deposits, and short-term US Treasury bonds. They can be transferred quickly over the network like ordinary money, but they are not issued by the state. They are issued by private companies that are fully dependent on the dollar-based financial system. And where does this push everyone? Into a cryptocurrency cloud. Over time, when part of the US national debt is placed into stablecoins, the United States will devalue that debt. The essence of this plan is to move the debt into what is called a crypto cloud, which would lead to a reset of the financial system. The result of such an operation would be that all other countries in the world are left empty-handed. This may sound like a crazy conspiracy theory, but a similar version of events was previously voiced by billionaire Michael Saylor, the founder and CEO of MicroStrategy. Moreover, he effectively advised President Donald Trump, quote, to sell all of America's gold and buy Bitcoin. Get rid of your gold. Sell all of the US gold and buy Bitcoin. In this case, trade becomes essentially free, because the proceeds from selling gold would allow you to buy 5 million Bitcoins. You demonetize the entire asset class linked to gold, while our geopolitical opponents continue accumulating it in their vaults. As a result, their assets lose value, while ours grow to $100 trillion. This would allow us to establish control over the global reserve system of capital flows, as well as over the network of the world's reserve currency. This naturally raises the question, how realistic is such a scenario, and would it actually work in practice? We believe that this is not just a workable strategy, but an inevitable course of events that will happen sooner or later. Perhaps not exactly in the form described, but it is precisely this concept that we will analyze in today's episode. Let's take a closer look at the statement that was made and examine the mechanism by which the United States could devalue its $37 trillion debt through stablecoins and Bitcoin. All of this is extremely interesting. Let's once again recall the statement made at the Eastern Economic Forum. It claimed that the United States intends to radically change the principles by which the gold and cryptocurrency markets function. Their goal, of course, is to transition the entire world into the so-called crypto cloud. And once that happens, the US would transfer its enormous national debt into assets like stablecoins and then carry out its devaluation, which would essentially mark the beginning of a new financial era. So what does debt devaluation mean in practice? And how does this actually work? Let's imagine that the total value of the entire global economy equals $100. Suppose we borrowed all of that money, and now we have an obligation to repay it. But why repay it through honest labor if we have a key advantage? We control the world's reserve currency. So instead of repaying the debt with the same $100 bill, we can simply create another bill of the same denomination out of thin air. As a result, there are now not $100 in circulation worldwide, but $200, while the amount of available goods remains the same. What happens next? Naturally, prices for everything begin to rise: real estate, stocks, gold, and other in-demand assets. Even food products that previously cost, say, $1 also become more expensive. Everything becomes more expensive because the money supply has doubled while the quantity of goods has not changed. This is inflation. When we repay the borrowed $100, formally, it looks like we fulfilled our obligations. But in reality, we cheated. Those $100 now have half the purchasing power they had before due to the dilution of the money supply. You can no longer buy the same amount of goods with them. We devalued the debt. Most people do not understand that this is literally one of the oldest financial tricks in history. This is exactly how the United States has been servicing its debt for a very long time. But devaluation is not the same as default. It does not mean refusing to repay debt. It means reducing the real value of the debt burden through inflation or currency manipulation. This process has been repeated many times after World War II, during the inflation of the 1970s, and even in recent history after the pandemic, when massive money printing was launched, causing prices to rise everywhere. This is a classic case where an increase in the money supply, while the volume of goods remains unchanged, leads to higher prices. Therefore, when Putin's advisor says at the forum that the United States may use cryptocurrency to devalue its debt, he is not telling us anything fundamentally new. He is simply describing a practice that America has been using for a long time. And this is exactly where stablecoins are needed to perform this trick on a global scale. To be clear, this is not about literally converting $37 trillion into stablecoins. Instead, dollar-pegged stablecoins backed by U.S. Treasury bonds are used, which allows obligations to be distributed across the entire world. In the event that these dollars lose value, the losses are shared among all holders of such tokens. But we will discuss the details of this mechanism a bit later. For now, this may be the most important economics lesson of your life. We owe it to entrepreneur Jeff Booth, the author of the bestseller The Price of Tomorrow. Just remember this at all times. The natural state of any economy is deflation. What does that mean? If the total amount of money in the world did not change, let's imagine that only a single $100 bill existed while technology continuously progressed, increasing production efficiency. Then prices for all goods would naturally decline over time. Goods would become cheaper due to productivity growth, while the money supply remained fixed. This is the natural order of things. This is deflation, a process in which goods become more affordable over time. However, the world we live in is structured very differently. The reason lies in the ability of governments to conduct monetary expansion, that is, to print new money. When this happens, we see headlines claiming that gold, real estate, stocks, or Bitcoin have reached all-time highs. But the reality is that these assets are not so much becoming more valuable on their own, rather. The dollar is losing its purchasing power due to the increase in its quantity. As a result, more monetary units are now required to purchase the same asset. When new money floods into the economy, all this additional liquidity, as it is called, must be placed somewhere in order to avoid rapid devaluation. That is why capital flows into so-called safe haven assets such as real estate, stocks, gold, and Bitcoin. This is why, in the long run, it appears as though their prices rise forever. In reality, they are merely preserving their real value, while the underlying money becomes weaker and weaker. But what if this exclusive privilege were extended beyond the United States, in other words, applied on a global scale? This is exactly where stablecoins are meant to play a key role. One might reasonably ask, if the United States already has the ability to devalue its debt through traditional inflation, why would it need to do the same using stablecoins? The answer lies in two factors: the distribution of costs and the strengthening of control. The fact is that when the US triggers dollar inflation, the negative consequences are felt almost immediately within its own domestic economy. Food prices are rising, housing costs are skyrocketing, and utility bills are increasing. In order to contain inflation, monetary policy has to be tightened, which leads to a potential rise in interest rates. The consumer price index keeps creeping upward, which naturally causes public dissatisfaction. However, stablecoins fundamentally change this equation, because their issuers place reserves in short-term US Treasury securities. As a result, as stablecoins grow in spread, demand for US dollars and US government bonds may increase, creating a partially self-sustaining system. Every transaction with USDT or USDC anywhere in the world is, in essence, the use of a digital debt receipt backed by US Treasury bonds. This means that users indirectly contribute to financing US debt even without purchasing these bonds directly. Consequently, if US debt is devalued through inflation, the burden of this process is distributed not only among US citizens, but is also exported worldwide through stablecoins. Thus, inflation turns into a kind of collective tax that stablecoin holders around the world are forced to pay, as their digital dollars lose purchasing power simultaneously. Technically, this is also true for the modern dollar system, given its global distribution. However, in the case of stablecoins, this market reaches a much larger scale, existing literally on every user's smartphone. And this is where we arrive at the next piece of this puzzle. Stablecoins can create the appearance of neutrality, since their issuers are private companies rather than government institutions. This allows them to avoid the political baggage traditionally associated with the Federal Reserve or the US Treasury. According to the relevant legislation, the right to issue regulated dollar-backed stablecoins belongs only to approved issuers, banks, trust companies, and non-bank financial institutions that have obtained a special license. And if corporations like Apple or Meta wanted to, they could simply create their own currency. Let's uslovno call it Metcoin. To obtain the necessary approval, they would essentially just need to curry a bit of favor with the president. How much money, in your estimation, would you plan to spend over the next few years? I think it would likely be at least $600 billion. In essence, stablecoins represent a level of control similar to central bank digital currencies, but without using their official branding. This is precisely why the rest of the world does not want to participate in this system. We see confirmation of this in the fact that countries are actively buying gold. This is the current reaction. Nations seem to be saying, "We don't need your stablecoins. Give us back gold." After all, gold was a universal standard for thousands of years, and now everyone simply wants to return to this proven system. But why is everyone refusing to participate? Despite the fact that, in theory, stablecoins should be 100 backed by real US assets dollars or Treasury bonds, and that each unit in circulation should have a real equivalent behind it, trust remains low. The main problem is that no private individual or foreign government has the ability to reliably verify this backing with absolute certainty. Companies such as Tether and Circle do publish reports. However, one still has to rely on the integrity of the issuers themselves and their auditors, who are mostly based in the United States. When it comes to trust in matters involving trillions of dollars, this becomes a real headache for other countries. Even if blockchain technology one day allows for full real-time audits of reserves, it will not solve the more serious problem, the fact that the United States always retains the right to simply change the rules of the game. The US government once made a promise to freely exchange dollars for gold. However, in 1971, President Richard Nixon unilaterally severed this link. From the perspective of the global community, this was a radical rewriting of the Rulesa breach of obligations that were effectively nullified. Therefore, phrases like "trust us" have no real value on their own. There is no technical barrier that would prevent the United States from taking similar actions today, this time in relation to stablecoins. It is precisely situations like this that give rise to deep global distrust toward transitioning to this new digital system. So, will the US actually go through with this? Today, we are inclined to believe that such a scenario looks highly probable, if not inevitable. Moreover, the US may already be experimenting with this concept, just not in the form that is discussed publicly. A vivid example is the already familiar Michael Saylor, who actively promoted to Trump the idea that America must have a strategic reserve in Bitcoin. According to Saylor's plan, selling the entire US gold reserve and using the proceeds to buy Bitcoin would have led to a collapse in gold prices. This would have harmed competing countries such as China and Russia, while simultaneously triggering a sharp rise in Bitcoin's price and increasing the capitalization of the American balance sheet. However, in practice, this did not happen. Under the Trump administration, the idea of a state Bitcoin reserve remained purely at the level of discussion and never materialized. The US stated that it would not use taxpayer dollars to purchase cryptocurrency, and as far as is known from open sources, no such purchases were made. It is unlikely that this will happen in the way Saylor proposed. However, an important nuance arises here. Even if the government does not openly buy Bitcoin, there are other non-public mechanisms that could be activated behind the scenes. Let us consider the company MicroStrategy. In essence, this corporation has turned into a public operator of the Bitcoin market under the leadership of Michael Saylor. It carries out continuous purchases of cryptocurrency and has already accumulated hundreds of thousands of Bitcoins to date. This raises the question, what if, instead of the US government directly buying Bitcoin and risking widespread panic, it would be strategically wiser to allow a large corporation to do this first? Such an approach would not be associated with central bank actions and could remain largely unnoticed. Later, if Bitcoin truly becomes a strategic asset, the US government could acquire a stake in MicroStrategy, just as it acquired 10 of Intel and other companies. Such a precedent already exists in historical practice. If you think about it, why should the US openly take risks by provoking a collapse in the gold market through direct trillion-dollar Bitcoin purchases or the forced issuance of stablecoins? And does it make sense to sell off gold reserves while they still remain on the balance sheet? A far more rational and pragmatic approach would be to transfer the initial initiative to private companies. By allowing corporations to conduct the necessary experiments and work out the mechanisms, the US government gains the ability to integrate already tested solutions at the right moment. This is exactly the way the United States has traditionally operated. First, innovations are born in the private sector, and once they reach a critical level of significance, they are adapted at the state level. Thus, the process unfolds more organically, step by step, and retains plausible deniability right up until the moment of official recognition. The core idea here is that there are many potential scenarios for implementing this strategy, and the probability of their realization is quite high. Such a step looks the most logical for the United States in the long term if it intends to take a systematic approach to solving the problem of national debt. But let's try to look even deeper. What could happen if the US actually implements this strategy and the world fully transitions into the so-called crypto cloud? The first and perhaps most obvious consequence would be a sharp redistribution of power centers. Today, the financial system is based on the dollar, which benefits America, but it still contains pockets of alternatives: gold, the yuan, commodity markets, national reserves. However, if stablecoins issued under the control of American companies become the key settlement instrument, the United States would gain not only dominance, but effectively a control panel over all global liquidity. Imagine this. Any international transaction, from buying oil to sending money to students from India or to one's family, passes through infrastructure created and licensed in the United States. This is no longer just control over the reserve currency. It is control over the very mechanism of money circulation. In essence, the global financial system could turn into a gigantic Apple Pay. But behind the scenes of such a scenario lies another factor: digital identity. To use these stablecoins, verification similar to Kiki would be required, which would automatically pull in massive amounts of data on every user. And here we enter a new dimension. The United States would be able not only to devalue its debt, but also to form a global surveillance system. This may sound like an exaggeration. However, it is enough to recall the history of the SWIFT system, which the US has already used as a pressure tool by disconnecting entire countries from it. Now imagine that instead of interbank transfers, we are talking about all digital transactions, from salaries to buying a cup of coffee. Being disconnected from such a system would no longer be a sanction, but an effective financial exile from the civilized world. That is why many states are trying to get ahead of events by creating their own central bank digital currency projects. China's digital yuan is a vivid example. Beijing understands that if it does not offer an alternative today, tomorrow all its exports will depend on American stablecoins and that it will no longer be setting the rules, but forced to accept them. Even Russia has joined this race and is actively testing the digital ruble. This raises the question, does the world have a chance to build a third path? Something in between US control and the attempts of individual countries to launch their own closed systems. This is where Bitcoin enters the arena. Bitcoin is fundamentally different from stablecoins because it does not depend on any state and is not backed by anyone's debt obligations. Its value is formed exclusively by a decentralized network. That is precisely why many experts believe that in the long term Bitcoin is capable of becoming that very digital gold to which people will turn during periods of instability. Yes, today Bitcoin is too volatile to become a global settlement currency. But if we think strategically, that is not even its mission. Its task is to be a universal store of value to which inflation or manipulation cannot be applied. And in this sense, it may become the foundation for a new global financial balance. Let's consider a hypothetical scenario. Suppose the United States truly transfers most of its debt into the digital sphere and launches a global stablecoin system. This would cause a rise in distrust among other countries, and they would begin actively accumulating Bitcoin in the same way they previously accumulated gold. As a result, a two-tier model emerges, a dollar club controlled by the United States, and a Bitcoin foundation that exists in parallel and does not depend on Washington. What happens next? If the US decides to use its advantage too aggressively, it risks pushing the world toward an accelerated transition into Bitcoin. If, on the other hand, it acts softly and gradually, it could maintain control for decades. This balance game is unfolding before our eyes right now. America is testing new instruments. China and Russia are accumulating gold, and millions of people around the world are increasingly using Bitcoin. This is no longer theory, this is a real struggle over what the financial system will look like in 10-20 years. There is one more point that is rarely discussed. Many people think that cryptocurrencies are a threat to the state. But in reality, the state can use cryptocurrencies to its advantage. Imagine that the United States not only issues stablecoins, but also becomes the largest holder of Bitcoin. Then it would have both a tool of control through stablecoins and a tool of protection through Bitcoin. Such a double maneuver would allow it to play on two fields at once. That is why many analysts believe that today's uncertainty around cryptocurrency regulation in the US is not chaos at all, but a well-thought-out strategy. Washington is in no hurry to set clear rules because it benefits from watching how the private sector tests different models. And when a working solution appears, the state will simply take it over and legalize it in the required format. Remember the internet in the 1990s. At first, it was chaos full of experiments and failures, but later the United States set the rules of the game and effectively turned the internet into its strategic asset. The same thing could happen with cryptocurrencies. So what awaits us in the coming years? Accelerated development of stablecoins and their integration into global finance, growing distrust in the dollar, and as a result, an increased role for gold and Bitcoin, competition between central banks of different countries, each trying to protect its sovereignty, and, of course, inevitable crisis because every such restructuring of the global system is accompanied by shocks. Perhaps we are standing on the threshold of the largest transformation of the last 100 years. If previously the world transitioned from the gold standard to the dollar, now we may witness a transition from the dollar to digital assets. And this transition has already begun. And here is the main question. Are we ready for this world? A world in which money will no longer be just paper or numbers in a bank account. A world where every transaction is part of a global chess game, and money itself is an instrument of power. We are living at a turning point in history. Perhaps in just a few years, we will look back and say, yes, That was exactly when a new financial era began, when the familiar dollar ceased to be absolute, and digital assets took its place. So pay close attention. It seems that history is unfolding right before our eyes.